Hey there, everyone, and welcome to the Final Bar. It's Monday, July 29th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a very rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Now, there's a lot of other things happening this week besides technical analysis, right? We have the next Fed meeting coming up tomorrow and Wednesday. We have a ton of earnings, including 4 of the Magnificent 7 names reporting on Tuesday, Wednesday, Thursday. We've already had some earnings flow so far today with some market moving potential. So where does technical analysis, exist? What does that mean at a time when it's all this other stuff that is causing assets most likely to move? Here's the thing. Technical analysis is not about predicting what could cause the markets to move. It's about analyzing investor psychology and investor sentiment going into some big announcement, during some big announcement like a Fed meeting or a press conference afterwards. After the announcement, to see how investors are digesting or sort of getting comfortable with whatever new news has been made public or widely distributed. So I would argue that charts are vital in this particular type of environment where uncertainty seems a little high, where volatility has become a little bit elevated, where we're entering in pun intended, some uncharted waters in terms of a Fed tightening cycle and inflation where it is and an election year and all of these sort of things that are happening. Charts can be the truth serum for the markets, telling you what's actually happening and helping you focus on those actionable ideas. With that as a long-winded intro, let's get right to the market recap and focus on how the markets changed on today's session. Basically a flat day, a choppy and flat day, but at the end of the day, directionally not really gaining to the upside or the downside. And I'm not surprised, to be honest with you. If you told me this was going to be a heavy earnings week, if you told me there was going to be a Fed meeting, if you told me there was going to be plenty of economic data coming out, I would tell you Monday, where not a lot of that has happened yet, it's probably a treading water day. This is sort of the appetizer before the main course that starts, I think, tomorrow with AMD and Microsoft reporting after the close, with the Fed meeting sort of getting going. That goes into Wednesday and then Thursday, of course. So the S&P 500 essentially not too far off of where we were on Friday's close. We finished today around 54.64. That's just slightly above Friday's close. The NASDAQ Composite, again, almost unchanged, right around 17,370. The Dow, still above 40,000, around 40,540, and that's down slightly from Friday's close. Note that mid-caps and small caps actually were down today. The S&P 600 small cap index down the most, down 0.7%. The VIX slightly higher, ended up being just below Friday's close, but by the end of the day, last 20, 30 minutes had a quick sell-off in stocks and a quick pop in the VIX, so right around 16.6. So we have volatility still in that sort of uncertain range between 15 and 20. We'll look at the chart of the VIX here in a short while as we continue our market recap. Looking at the fixed income markets, that is, you can see the yield curve overall moved slightly lower. The 10-year yield was down to around 4.18. The long bond yield's around 4.43. Bond prices, of course, are moving up a little bit when the yield curve is moving down. There's that inverse relationship between bond prices and yields, if you're not familiar with what I was alluding to. So, interest rates overall have been in certainly in a downtrend, and that, arguably is one of the I think great potential tailwinds for the small cap space. Is when rates are lower, that means it's cheaper to borrow. Smaller companies need to usually borrow quite a bit. And so often when rates come down, it usually is a good sign for small cap stocks. And we've certainly seen that trend. Today was, sort of against that trend with small caps down a bit while large caps were essentially sideways. But larger themes certainly to keep in mind. Keep an eye on the dollar, of course, as well. We have an eye on the dollar index, which is $USD. On the Stockcharts platform, around 107, sort of that level. It's the upper end of the range we've been in for the last 12 months or so. I think a pop above 107 could mean very good news again for small cap stocks. Not so good news for large cap companies, which tend to have a lot of revenues outside the U.S. that they then need to convert back to U.S. dollars. So stronger dollar kind of hurts the mega cap names more than smaller names. Commodities, to be honest with you, kind of a sell-off there earlier in the day, but by the end of the day, gold and other commodities came off, but sort of made their way back toward the zero line through the course of the day. Gold was still down about 0.1%, same for silver, so no real change from Friday's close. Crude oil prices, though, really came down from Friday. Bitcoin overall hit 70,000 once again. The 70,000s repelling any gains. In the last 24 hours, you've seen Bitcoin push up to that big round number, almost to the tick. You could see we roll off from there. So big round numbers are a well-documented phenomenon in the financial markets. I feel like with cryptocurrencies and especially with Bitcoin, boy, I've seen this so much. I just keep repeating it because it tends to work. When we're below a big round number like 70,000, I'd be amazed if we just blow through it without having at least some sort of dramatic pause. And that has been the truth when we've been below big round numbers, when we've been above them. Look at the charts, draw a horizontal line at every $10,000 increment on Bitcoin, and you will find we touch it and hit it a lot. Ethereum, while Bitcoin is down slightly to around 67,300, Ether price is actually moving slightly higher, up about 1.5% to 3320. We'll call it just slightly below that. Let's go to the 11 S&P 500 sectors and see how things played out today. You can see consumer discretionary is your top performer, up 1.7%. Communication services number 2, up 0.9%. REITs and utilities, two fairly defensive sectors, coming in at third and fourth, both up about 0.4 to 0.6%. 4 of the 11 S&P sectors finished in the red. Energy, I mentioned crude oil prices coming off. Energy, the worst performer, down 0.9%. Technology, down 0.4%. Financials and industrials, both down about 0.2%. So some days you have a clear offense up, defense down, or value versus growth. Today, kind of mixed. You've got some growthy stuff and some defensive sectors at the top. You've got some value sectors and the growthiest, or one of the growthiest sectors, technology, at the bottom. So sort of a mixed bag. And again, that makes sense given where we're at, given the fact that we've got a lot of news flow coming out over the next 72 hours. Certainly going to be a lot of news. It's interesting that technology is down, while on semiconductor is actually the biggest gainer in the S&P, up over 11% today. We'll get back to that chart with others here in a moment. If you're wondering why the XLY did okay today, that's Tesla up 5.6%. Again, Tesla, the chart of Tesla is not particularly strong. It's actually, at best, in kind of a flag pattern here. We talked about it as a pennant pattern. If you look at the little preview chart, you can see the big run from late June, early July, right after the 4th of July holiday. You have this sort of consolidation period, lower highs, lower lows. That's a pennant pattern. We gapped below there last week, which to me suggests a downside trajectory. Today, kind of bouncing off of that 3-day stretch around 220 that we experienced Wednesday, Thursday, Friday of last week. Alphabet up 1.5%. On the downside, 2 of these magnificent 7 names were down. NVIDIA, one of those, down 1.3%. Netflix slightly lower as well. Let's go to daily chart of the S&P 500, sort of see how things played out. No real change, to be honest with you, with what we talked about at the end of last week. The S&P, I think, has done the initial breakdown, which is breaking down through trend line support. This pink trend line, I've called it sort of the trend line, or the trend line to rule all the others, or something along those lines. Sometimes the market does not seem to follow trend lines particularly well. Other times it seems almost like a clear visual representation of the pace of the trend. What you have to remember is when you're using a log scale on your y-axis, which I would strongly recommend everyone do for pretty much all the time. The way you do that on Stockcharts, by the way, just below, make sure you select log scale instead of arithmetic scale. And if you're using Stockcharts ACP, you have a similar setting. If you right-click on the price bars, you can change that scale as well. But if you look at what's happening is when you draw a trend line on a log scale chart, that trend line represents a consistent percentage gain because the y-axis is scaled by percent. So if I draw a trend line of a particular slope and have a straight line, that line represents a consistent percent appreciation in whatever I'm drawing that line on. It's super helpful with stocks because this line might represent a 3% annual gain or 6% annual gain or whatever it is. You don't really need to know that value. What you need to know is as long as we hold above that trend line, as long as we keep testing it, that basically tells you that the lows are creating a very consistent appreciation in that asset over time. And why it's important is because when we break that trend line, which we did last week for the S&P 500, that tells you something's different, right? It may not be the end of the world different, may not be 20 to 30% correction kind of different? It could be. What it tells you, though, is we've had that initial break. The market had a particular trend. It was appreciating at a particular consistent pace. And now that pace is changing. So we see the S&P break down through that trend line last Wednesday. As of today, we're kind of holding that 50-day moving average. And, last week we touched 5,400 on Thursday's session. Friday we bounced up a little bit. Today we're basically an inside day, sort of inside the range that we set on Friday. So this is literally a holding our breath moment to see what's going to happen Tuesday and Wednesday, where again we've got a lot of earnings. We've got the Fed meeting. That certainly can provide an upside or downside catalyst. I think the S&P above 5,400 is still a decent chart, still pretty good. We're still making higher highs and higher lows. The S&P below 5,400 would mean not only have we broken trendline support, we've broken the 50-day moving average for only the second time this year, and we're breaking through that price gap from early June, which I think is a key level to watch. So we're right at that support. The question is, do we hold? The momentum overall is remaining fairly constructive, right? As long as the RSI pushes down to around 40, but doesn't get much lower, that tells you that the conditions are actually still quite strong over the longer time frame. So pivotal moment this week, and again, a lot of news flow happening as the S&P is testing a key level of support. So I think a lot to pay attention to. Some other themes here on sort of the macro side to think about. We're getting to the month of August, and I'm going to be doing my monthly chart review with my Market Misbehavior Premium members on Tuesday of next week. So great time to join, by the way, so you don't miss next Tuesday's discussion. One of the things we'll talk about is just the seasonal patterns. Now, August and September actually tend to be pretty consistently weak if you look at a large amount of data going back to the 2009 low. But if you only look at election years, which is what I've done here, I've just selected the last 5 election years, you can see that August has been up 100% of the time. 5 times out of 5, going back to 2004, August has been a positive month and one of the best performing months in terms of average returns at an average return of positive 2.3%. So August actually in an election year tends to be remarkably strong. Again, I would say the normal, seasonal tendencies, and that's what happens is if you select all these other months, you can see August actually starts to get worse and worse because as I select some of these other months, you can see that, or some of these other years, you can see that August actually tends to be one of the worst, months in terms of an average return of 0.1%. And we're only up about 60% of the time. So, we're thinking about as you look at look at the data to think about which of these, what August we're going to get. Are we going to get sort of that, strong, election year kind of August, or are we going to get the weak August that we often get in a normal routine? All right, let's go back to some of the other charts here, and I would point out the chart of the VIX. Let's see, here we go. Volatility, again, remains elevated, and I think of the VIX and volatility in terms of volatility regimes and certain ranges. And again, this is not a perfect system. I would not manage a portfolio based purely on the Dave Keller VIX range theory here, but this is the general way that I like to use this indicator. A VIX below 15 is a low volatility, most likely quite bullish environment, which is what we've seen for much of the last 12 months. A VIX above 15 but below 20 is usually a pullback. A VIX above 20 means elevated risk of a much deeper correction. A VIX above 28.5 to 29 is usually only reserved for big time secular bearish markets or much more protracted declines. Does not happen very often, but when it does, you really want to at least be defensive or thinking defensively because the market headwinds are very, very real. Right now, the VIX is between 15 and 20, which means not the end of the world, but not great. It's sort of classic behavior for pullbacks. The last time we were in this range was in April of this year, when we had the brief pullback, about 2 to 3 weeks, coming off of a late March low, finding a low the third week in April before increasing to test 5,700, or almost there, in July. Also want to look at the chart of interest rates, because if we go to the 10-year Treasury yield, we can see that, overall, again, the trend in yields has been down, right? Interest rates have been coming down. So we're going to get the next Fed meeting here this week. Wednesday is when we get the press conference and the announcement. No real change expected. The market's pricing in a no change in the Fed target range. but pricing in almost a 90% certainty of the first rate cut coming in September, and the September meeting is only about 6 weeks away from where we're at today. So, that's certainly what the market is pricing in. So you expect the short end of the curve to be coming down through the remainder of this year. The 10-year point is certainly coming down from mid-April to now late July, or late April to late July. The trend in rates has been down. And again, that tends to mean different things for different types of companies. But that environment in particular usually is pretty good for small caps, which is why I keep coming back to those as a potential area that's really, from a technical perspective, starting to improve, while other things are struggling. Let's look quickly at the chart of Bitcoin, and then we'll finish off looking at some individual names when we look at Bitcoin intermarket analysis. The chart of Bitcoin, I mentioned hitting that 70,000 level, and again, big round numbers just tend to have meaning for a lot of things, but especially Bitcoin. Look at the number of times we've broken briefly above 70,000, only to come down a couple sessions later, and that's kind of been the story for Bitcoin in 2024. It's 70,000, that impossible ceiling to break above. Now you can move that up a little more and say it's 70 to 74,000, or maybe 72 to 74,000 as being the more consistent resistance. But I think of it as that big round number. And every time we've tried to get a foothold above that point, that has been repelled, and a day or two later, at the most a week later, we've come right back down. So we're testing it again right now. So I think, again, the proof is in price. If we can get above 74K and really eclipse that March peak, I think the upside potential in Bitcoin is very, very real. But if you look at the daily chart here, look at the weekly chart, certainly you can see the importance of that range around 70 to 74. We're kind of at that point where we've experienced resistance previously. I'd be very keen to know if that's gonna happen again. I do own some Bitcoin in terms of full disclosure here. All right, finishing off, let's talk about some of the stocks on the move in the news. A lot of these are earnings names. On Semiconductor actually just reported before the open today. Nice gap higher. So the first semiconductor company reporting this week, decent reaction, right? Up about 11.5%. We made a new 3-month high, which is pretty impressive. Today's gap higher also gets On Semiconductor back above the 200-day moving average. And I think that's key here, because in December of last year, in March of this year, in June of this year, in July of this year, we have had failed attempts to get back above the 200-day moving average. Charts above an ascending 200-day moving average are those long, slow, and steady gainers that you kind of want to have in your portfolio if you're a trend follower. And On has not been of that characteristic until again today as we gap higher. Again, the question for me is, do we get above that July swing high, which is around 79? We closed right there today. We did trade briefly up to around $80 a share, but I'd love to see if we can push just slightly above that level, make a higher high, and that's after bouncing off of clear support around 67.50 over the last week. SFM is a company reporting after the close today. This is Sprouts Farmers Market, which is a grocery store. And what's interesting today, just in terms of candlestick analysis, we have a bearish actually it's not quite a bearish engulfing pattern. I have to tap the brakes on that. It looked like we might actually close below there, but if you know your candle charts, a bearish engulfing pattern is you have a big up day and a big down day, and the down day actually engulfs the range of the up day. And when you're looking at the real body, the open to close range. So does anyone know? Here's your quiz question of the day. You technical analysis fans, what does it mean? It's not a bearish engulfing pattern because we didn't get below there, but it is a particular pattern if we break at least 50% below that first candle. Do you know what that's called? It's actually called, I have to remember, a dark cloud cover candle is what that is. So a dark cloud cover is basically a bearish engulfing pattern, but we don't quite get below the open of day one, but we do get at least 50% of the way through there. Our friends in Japan, many who have used candlesticks for centuries in the Japanese markets would agree that would be a dark cloud cover candle. It's also bearish, by the way, and suggests the next 1 to 3 bars most likely lower. Be looking to see if we test 80.50 and test that support. Again, reporting after the close today. So this was selling off over 2% going into today's report. We'll see what that looks like after the close today, and if there are buyers coming in and buying in on that short-term weakness. But if we get a gap down, I'd be eyeing that 50-day and the swing low from mid-July. That makes sense to me from a technical perspective. What else can we look at? PayPal coming out tomorrow before the open. A bunch of companies reporting before the open today. Just to look at some of these charts and what to think about. PayPal's an interesting chart because it's really been sideways here in 2024, right? Cover up the left half or left 2/3 of this chart and just look at the right side. This is 2024. We've been range bound between around 68 to 70 on the upper end, between around 56 to 58 on the lower end. That's been the range, and we're bouncing off of the lower end of that range. But the challenge with PayPal is we really haven't been able to, make any real headway on the upside. So, buying short-term weakness, buying support as a trade back to retest the previous highs. That's a tough thing to do going into an earnings report tomorrow, pre-open. We kind of missed the boat on that one. But, if you do own this, I would be thinking of this recent, these recent lows as certainly a clear support level. If you break that $50 a share, that's back to the October low. That would seem like the next logical step on the way back down here. But break out, and I'd be watching that resistance sort of 67 to 69.70. That's the resistance that we've experienced through much of 2024. Can PayPal get above there? Other payment processors, other MasterCard later this week as well. Something to watch. AMD is one of 4 key companies reporting after the close. And again, I'm highlighting some of the ones that I think are important. AMD is an important one. You saw on Semiconductor bouncing higher today. AMD has actually been in a bit of a downtrend. It's trading below its 200-day moving average. The last time we undercut the 200-day was here in October of 23, which was just before a nice 3 to 4 month rally. So I don't know if we could expect the same, but I would say we're still sort of testing that support from May. Can we bounce off of there and find some upside potential off of that oversold level as we test the low from May? That's a question for AMD. Microsoft, one of the first Magnificent Seven name reporting this week. The chart of Microsoft is not bad. Let me be clear, right? It is still in a primary uptrend of higher highs and higher lows. The problem I have with Microsoft is in the tactical time frame, it's looking like what a lot of tops look like, right? There's that initial downtrend. Same thing as you saw kind of in April, right? What happened in April was you started to find stability. You started to break above, no longer make new lows, started to make new swing highs, make higher lows. You saw the momentum shift. All those things sort of told you that Microsoft was starting to find its footing. Look to see if there's that same sort of thing. Earnings can often be a great upside catalyst, but a downside catalyst as well. And if we break down the 200-day moving average, the swing low from April right around 390 would be the level I'd be immediately watching to see if you could hold that on a pullback. 2 more to tell you about: Starbucks and Caesars. These are 2 names I wanted to highlight because they've been in a primary downtrend, but they're testing lows. You can see on Starbucks, we're testing support from May around 72. For CZR, which is a gambling name, we didn't quite get to 32, the May low, but we got down to sort of 33-ish, which is, I would argue, sort of testing that low. These are 2 stocks, again, below downward sloping moving averages. Can earnings be the catalyst to help them bounce off of those swing lows? If not, I would be cutting losses below that support level, because if we break that support, there's not a lot of daylight below, or not a lot of support levels below that level that we've seen in quite some time. So in that case, I would be sort of avoiding those charts until you see signs of accumulation. We may be seeing that here as July wraps. Can August be a positive story as we bounce off support with earnings as the catalyst? That's why I'd watch Starbucks and Caesars. Folks, that's a wrap for today. A lot coming on through the course of this week. We'll be here with you along the way. We'll be traveling to Las Vegas for the Money Show. So if you're going to be attending, please make sure you say hello when you get to my sessions on Friday, and then on Saturday morning. Would love to meet you, or maybe in some of the cocktail hours. Please come up and say hello. Pleasure to meet you. Always a pleasure to meet some of our viewers. But until then, have a great week, and we'll talk to you soon. Bye now.